rising unemployment was always the key for inflation to go down. Look at the chart, for example, that I'm showing you right here. In white, core CPI. In orange, the unemployment rate. Every time we saw the unemployment rate rising, it took a few months later and we saw core CPI peaking and going down pretty much every single time. Yet when we talk about a time of economic confusion, what are we talking about here? Look at core CPI in white right now, peaking and already dropping, yet the unemployment rate in orange not ticking higher at all. And that opened the path for the soft landing theory, that it is possible to drop inflation down without raising unemployment higher. You look at this correlation and you say that, hey, team soft landing, they got a pretty good argument here, but that is contingent on this is becoming the exception, not the rule. There is always a first time for everything. Could it be that this is the first time when we see inflation moving down, yet the unemployment rate not moving higher? Sure, but according to historical correlation, this will not be the case. So how do you explain what's going on here right now? Which one is lying? Is it core CPI dropping, or is it the unemployment rate not rising higher? Who's lying here? Well, we know that we have a lot of data that core CPI is indeed cooling down year on year. Sure, month over month, it continues to move higher, it continues to stick. A little bit of cooling, but it continues to stick, and it's moving higher in certain categories. But year on year, core CPI is down. The question now becomes, is the unemployment picture really as good as it's being presented right now? Hold that thought. Because in part number 2 in the soft landing theory, it's not just inflation moving down while the unemployment rate not moving higher. It is also because the Fed will cut rates. Because inflation is going down, mission accomplished. Why continuing to raise rates higher? So the Fed will end up cutting rates, and this will be good for the economy and certainly very good for the stock market, and you have to buy right now. Here's what we know about the correlation of rate cuts versus the unemployment rate. The Fed funds rate in blue, the unemployment rate in orange. Every single time, Fed funds rate peaked and the Fed started cutting rates, that was the moment, right there and then, when we saw unemployment rising higher. So the historic correlation says, number one, the Fed cuts rates, the pivot happens, then the unemployment rate moves higher, and then we see inflation coming down, which is, by the way, the accurate part of the Phillips curve. The fallacy of the Phillips curve is if you have low unemployment, you're going to see inflation being born in the economy, which we now know that is false. But the other part is to take inflation down, the unemployment rate must move higher. So again, where is the disconnect? Why are we seeing inflation cooling down first, unemployment not moving at all, and the Fed funds rate remains as it is and increasing? Remember when I said that maybe the unemployment picture is not as good as it's being presented right now? What am I talking about? How about this? We know that by watching corporate earnings and listening to all of these companies reporting and saying that we have a problem in our cost structure right now. And we continue to hear layoffs after layoffs after layoffs. Well, we now know that layoffs are up nearly 5-fold so far this year, with tech companies leading the way. So how come we're not seeing this reflected in the employment data we're getting? For example, on Friday, we got the headline, 236,000 jobs created in March. And of course, they described this as, the labor market is cooling down. But 236,000 jobs, that is above the historic trend. That is a lot of jobs being created right now. So again, where is the disconnect? Is it that the jobs market is not really as good as being presented right now? Or is it the fact that inflation is not going down as we're being told right now? Let's dig deeper. In the report, it says that average hourly earnings grew by 0.3% from the month before, a slight uptick from the 0.2% seen in February. So we have wage inflation actually moving higher month on month. On the other hand, on an annual basis, earnings increases moderated to 4.2% from 4.6% the month before. Now, the bulls would look at the year-on-year number. The bears would look at the month-over-month number. The bulls would say, look, wage growth is actually going down. The bears will counter and say, but this is due to the base impact from last year. You got to look at the month-over-month, and the trend is going higher, which means we haven't seen the end of inflation yet. How do we settle this argument? How about we look at the data, what the data says? When we look at the Fed swaps, for example, in post payrolls, they actually moved higher, and now they're in alignment with the Fed, at least for the next meeting. What are we talking about? We're talking about Is it going to be a pause or is it going to be 25 basis points in the next meeting? In the aftermath of the payrolls, the odds for another 75 basis points went higher, took the lead 71.2% to a pause with an odd of 28.8%. So right now, the majority see 71.2%, see the Fed raising rates by 25 basis points in the May meeting. Of course, all of this is contingent on the next CPI. But for now, the market looked at the data and the market sees more need for Fed rate hikes, meaning that the inflation episode is not over yet. So when we talk about the disconnect, what if what we're seeing right now in the core CPI is just a mere dip, and then we see it moving higher again? And that explains why the unemployment rate is now moving higher. And if that is the case, then the bond and the stock market are wrong in the assumption that the Fed will indeed pause and start cutting rates anytime soon. The disconnect between the Fed funds rate and the 10-year has to be resolved right now, which means if this view holds, this week we will see a pop in bond yields. We will see a pop in the dollar, and that's not going to be good for the equities market. But you got to remember, when we talk about the disconnect, part number one, core CPI is just dipping, and it's going to rebound higher, and that explains why the unemployment rate did not spike. But explanation number two is, what if the unemployment data that we're getting right now is misleading? What am I talking about? We usually talk about job openings as, oh look, this is inflationary, the economy is so strong, the jobs market is so strong, we have more jobs than hires. We have more jobs than anybody who's unemployed in the country. What if job openings is a fugazi? A bunch of companies list a bunch of jobs on Indeed, on whatever platform they use. Does that really count as anything at all? Is the company really looking to hire folks because they have an open listing right now? That is something to think about. But most importantly, when we look at the report that we got this Friday, the economy actually lost 14.6 thousand jobs in retail trade, lost 9,000 jobs in construction, lost 1,000 jobs in manufacturing, and another 1,000 jobs in financial activities. And the majority of the gains in jobs in the economy led by leisure and hospitality, followed by healthcare and social assistance, and then government, and after that comes professional and business services. But can we say that this economy is indeed strong and the jobs picture is as good as being represented right now in the news media, for example, when the majority of job gains are being created in three sectors: leisure and hospitality, healthcare, and government? We'll look at the 3 months change, meaning the year-to-date change in jobs. Financial services actually lost jobs net, so did information, and so did utilities. And the job creation so far in mining, construction, manufacturing, wholesale trade, retail trade, transportation, and warehousing is actually anemic. The majority of the gains coming from government, leisure and hospitality, private education and health services, and professional and business services.